discussing what is the structure of the Indian banking system. Okay. But in order to understand the structure of the Indian banking system, we first need to understand the Indian financial institutions, because the banking institutions also falls under the financial institutions. Okay. So Indian financial institutions, so we can divide the Indian financial institutions into two parts: banking institutions and non-banking institutions. And when we will talk about banking institutions, then we can further classify them into three parts: commercial banks, cooperative banks, payment banks, and small finance banks. So this third criteria is a new emerging criteria. Lots of payment banks are emerging and lots of small finance banks are emerging. Okay. So we are going to talk about in detail about all these three criterias. And then let us talk about non-banking institutions as well. So when we talk about non-banking institutions, then they can further be classified into these criteria: development banks, insurance companies, NBFCs, non-banking financial companies that we say, mutual funds, pension funds, and primary dealers. Okay, so these are a quick criteria in which we classify the non-banking institutions. We'll be dealing with one by one each of these criteria as the session, as the course progresses. Okay, so your entire course has been designed in such a way that you will be talking about all these types of financial institutions. But since here we are seeing some of the non-banking financial institutions, and your course talks about your course is about banking only, so our focus will be greater on the banking institutions rather than the non-banking institutions. All right. So as we discussed that banking institutions can be classified into commercial banks, cooperative banks, payment banks, and the small finance banks. So let us first begin with the commercial banks. Okay. I'm going to talk in much more detail about commercial banks in today's session. Okay. And out of the commercial banks, we are going to talk about public sector banks. Okay. Public sector banks. What are the public sector banks, and what role they play in the in the functioning of the economy? It's an important discussion, and we should know about it. The importance of public sector banks. Okay, and how the public sector banks came into existence. Okay, we are going to talk about all such things in today's session. Right. So when we talk about public sector banks, then there are two types of public sector banks that we see in our economy. The first group is called the nationalized banks, and the second group is called the SBI group. Okay, State Bank of India group. So both are called the public sector banks. Okay, the nationalized banks and the SBI group. And when we talk about nationalized banks, then nationalization of the banks took place in 1969, and last year in July 2019, we saw the 50th anniversary of the nationalization of the banks. Okay. Then the important question is that why bank nationalization was required. Okay. We are going to talk about in much more detail about nationalized banks, why nationalization of the banks was required, and what role the nationalization play, and what was the reason behind the nationalization of the banks. We are going to talk about in detail. We are going to have a detailed discussion about bank nationalization in today's session. All right. But before that, let us quickly see the current picture of the public sector banks in India. Okay. So we talked about that public sector banks are in two groups: nationalized banks and SBI, State Bank Group. Recently, what happened, like from the 1st April, 2020, what has happened that 10 public sector banks have been, amalgamated into 4 big banks. Okay. So due to which, what has happened, now there are only 12 public sector banks in India, While last year there used to be 27 public sector banks. Due to this amalgamation activity which the government has taken in the name of the banking reforms. Okay, so government is saying that we are doing banking reforms because our banking sector needs these kinds of reforms. Okay, there are various reasons. We will talk about those reasons as well. But the current picture, I'm familiarizing you with the current picture. And if you read on the newspapers and the business magazines, and if you watch the news channels, business news channels, then you must have heard about this, that the government has amalgamated 10 public sector banks into 4 big banks. Okay, and the current status of public sector banks is that there are only 12 banks, public sector banks, while there used to be 27 banks. Now, what is the status of the public sector banks in India? Okay, so we can say that the public sector banking system is very underdeveloped in India, given the size of the economy that we have. So we have a very we can say that we have a very underdeveloped banking system given the size of the economy. And why we are saying that? Just a second. Why we are saying that we have an underdeveloped banking system? Because why we are saying that we have an underdeveloped banking system? Because when you will see the global picture, that how many of our public sector banks or how many of our banks are in the global top 100 list, then you will see that there is only one bank in India which is in the global top 100. So can you imagine our size of the economy? And on one side, we are saying that we have a total of around our GDP stands at second or third position, and given the size of the economy, we have only one bank which is in the global top 100. So it gives you a perception that our banking system is very underdeveloped banking system given the size of our economy. And let us talk about the share of these public sector banks in the Indian economy. So these public sector banks have around 70% of the market share in the Indian. So out of the total market share of the Indian banking system, 70% of the share belongs to the public sector banks. So means public sector banks have huge share, but when we talk about their performance, so they lack in performing. Okay, so since they have the 70% of the market share, it means that the entire onus of development lies on these public sector banks. Development means economic development. The entire onus of economic development falls more on these public sector banks. But what have been observed, that on every performance parameter on which you can measure the performance of the banks, the government has found that the public sector banks are inefficient compared to their peer groups. So compared to the private banks, compared to the foreign banks, the public sector banks have been found to be inefficient, and that's why the government is saying that our banking system is underdeveloped given the size of the economy. Okay? I'll share an interesting write-up about this, which was published in the economic survey of this year. If you read economic survey, then you can find this write-up, or I'm going to share this write-up on Moodle course page as well. So those students who are interested to know more about it, the current status of the public sector banks, they can read that document in detail. But the important gist of that document is that our banking system is underdeveloped. The public sector banks have, despite having the 70% of the market share, they have failed to perform. Okay, and they are inefficient as compared to their peer banks, as compared to the private banks, as compared to the foreign banks, on every performance indicator on which the government is trying to measure them. All right. So that's a quick picture of the current status of the public sector banks in India. And with this picture in our mind, I'm going to talk about nationalization. Okay, so how these public sector banks came into existence. Okay, and what was the reason behind the creation of these public sector banks, and what is the current status of the public sector? So you already know the current status. Now let us go into the history and let us talk about why these public sector banks were created and how the public sector banks came into existence. All right. So is it clear to everyone the discussion so far that we have just discussed in today's session? So let us begin our discussion on nationalization and what do we mean by nationalization, why such a step was taken by the government to nationalize the banks, and what happened when the bank nationalized, was nationalized. All right. So I discussed that in the last year we saw the 50th anniversary of the bank nationalization that happened on July 19. So nationalization happened on July 19, 1969, and in 2019 we saw the 50th anniversary of bank nationalization. All right, so 50 years have gone after bank nationalization. Let us try and assess that whether these banks have been able to meet the objectives uh, because of which the bank nationalization took place. Right? So I think after this discussion, you will be in a position to answer this question. Okay. So 50 years of bank nationalization. So the history says that what happened on July 19, 1969, that government nationalized 14 banks. Okay, with a deposit of, so these banks were having deposits of 50 crores each during that time, and government nationalized in the midnight of July 1990. And what was the status of these 14 banks? These 14 banks were having 85% of the bank deposits lying with them, of the entire country lying with them. Okay? And all these 14 banks were in the hands of the private players. Okay, so private players were controlling the 85% of the bank deposits of the country at that time. You can imagine the scale at which they were operating in 1969. Okay. Then in 1980, government again did the second, stance of nationalization, where it nationalized 6 more banks. Okay, and the core objective for nationalization was to energize priority sectors. Okay, the government's objective was to give more, impetus, give more, focus to the priority sectors, because what was happening that these private banks were focusing more on the large businesses dominated credit. Okay, so they were basically, you can say that they were basically making their policies, they were basically lending to some of the large businesses. They were not focusing on the priority sector areas, which was priority for the government, and these banks were not taking care of the socio-economic development agenda of the government. Okay, so this was the status 50 years back, or from today's date, let us say 51 years back, when the government thought about nationalizing the banks. And by nationalizing means government acquires the majority of the stake in these banks. So let us say these banks become public sector banks when the government nationalized these banks. Moving to the next slide. Now let us talk about very briefly about the economic situations in the 1960s. What was the situation of the economy in the 1960s? Situation of the economy in the 1960s. So the very first line you can read that India's economy was not in a good position during the decade of the 1960s. We were facing problems. We were facing we were fighting wars with our neighbors. We were facing natural calamities. we were facing, economic crisis. We were facing, uh, we were not in a position to feed our population. Okay, so these were the situations. Okay, so I'm going to come on it one by one so that you can have an idea that what was the situation during the 60s and what led the government to nationalize these banks. So in 1962, we fought a war with China. We lost that war. In 1965, we fought a war with Pakistan. Uh, okay, so whenever any government or any economy fights a war, then it puts immense pressure on the public finances. So putting immense pressure on the public finances means the public expenditure increases. Okay. Public expenditure increases means that the government is expending more on the war front. Okay? So there is a disbalance between the revenue and expenditure of the government, and you would have read economics, public finances. Then that fiscal deficit will increase. Okay. Uh, Throughout in 1965 and 1966, so what was happening on the uh, natural calamity front? So Indian economy faced two severe drought situations, one in 1965 and other in 1966. And because of this drought-like situation, we had food shortages and compromised our national security because now we were dependent on the USA for food shipments. So we made a deal with USA under which is called PL 480 program. So it's a law where India used to import food grains from USA uh, by 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 using rupees. Okay, so India was not required to purchase that food grain giving dollars because we lacked foreign exchange reserves at that time, and we could import the food grains by paying in terms of rupees. Okay, so this was the deal that was made by between the US government and the Indian government that we call PL 480 program. So we were facing food crisis, and we were importing food grains from the US. Now let us talk about the economic situations. So there was a balance of payment crisis as well in 1966. BOP crisis. The BOP crisis means our imports were much more than our exports, and when the imports are much more than exports, then we say that there is immense pressure on our foreign exchange reserves, and then the balance of payment crisis comes in. So on the economic front, we were facing balance of payment crisis. And because of these, pre circumstances, what happened? Government decided to have a plan holiday during 1966 to 60. You must have heard about plan holiday in Indian economy. Must have read about it. So plan holiday means the government stopped the 5-year plans and government took a break in between. So under 5-year plans, what happens? Under 5-year plans, meeting is unlocked. Under 5-year plan, what happens? That government, designs the plans and government makes the public expenditure and on the pre-designed policies. Okay. So when government stopped these 5-year plans, it means that public investment stopped. Okay, and it was reduced. Public investment was reduced, so it led to the reduction in the aggregate demand because all these things are connected. If you know this equation of economics, so y is equal to E plus I plus G. Okay. So G also plays an important role. G also plays an important role in in Y. Okay. So public investment stopped. So overall, it impacted the consumption. Okay. So the treasury was near empty. Means GDP was not increasing at that pace. Economic output was shrinking. Okay, prices were rising. So look at the problems that we were facing during the decade of 1960s. Okay, public morale was low. Because we say that the decade of 1960 to 70s was a lost decade for India. Okay, and what was the situation? The economic growth was very low. and economic growth, our economic growth was lesser than our population growth. Uh, Agriculture, needed capital infusion, or agriculture sector. So you all know that Indian economy is an agriculture driven economy. It was an agriculture driven economy during that time, but our agriculture sector needed capital infusion. It needed money. Agriculture sector needed money. Okay. In order to initiate the green revolution, so government was thinking about green revolution, but there was no money for the agriculture sector. Who will pay the money? Of course, the banks should play a will have to play a greater role in order to give money to the agriculture sector. But what was the situation with the banks then? There were 14 major banks having 85% of the deposit lying with them, but they were not ready to pay to the to lend to the agriculture sector. They were not lending to the agriculture sector. Their business was only for the big commercial houses, big business houses. Okay, so this was our economic situation in the 1960s. The government thought about it, and let me move to the next slide. Government thought about it, and government noticed, three important neglects which these private banks were neglecting. Okay, the disbursal of the rural areas and small scale borrowers was very less, so they were giving very lesser loan to the rural areas, despite there were regulatory norms under the Banking Regulation Act, but they were not following this. The loans by commercial banks to industry nearly doubled. So look at this figure. From 1951 to 68, the loans to the industry, it doubled from 34 to 68%, but agriculture loans, it remained less than 2%. Okay, so this was the situation. So these banks were not paying loans to the agriculture sector, and India was not in a position to feed to its population. Okay, we needed to import food grains. Can you imagine the situation? The government of the time, believed that banks failed to support its socio-economic objectives. The government thought that the banks are not cooperating with us. The banks are not supporting with us in keeping our agenda of socio-economic objectives. And socio-economic objective means that government wanted to uplift the poor from the poverty. Government wanted to give a boost to the agriculture sector. Government wanted to increase the food grain production. Government wanted to build hospitals, build schools. But these banks were not let us say cooperating with the government. These banks were not supporting the government. Okay. So this is where the government decided that it should have a greater control over these banks. Okay, because these banks are not helping us these banks are not supporting us in our social economic objectives. The government thought about that it should have a greater control on these banks. Okay. Let me move to the next one.